Hey guys, what's happening? Eric Garcia, financial advisor. I want to go over 3 questions that are really important that are going to help you withstand some of the volatility that we're seeing in the market. If you've been paying attention, you saw that last week we had one of the worst weeks in the stock market since 2008. Compliments of the coronavirus. I personally think that the market's been looking for an excuse to pull back a bit. Regardless, the market was pretty funky last week, and it just so happened to coincide with my family vacation in Disney World. So made for an interesting trip as I'm at Disney World trying to enjoy the roller coasters, the ups and the downs, watching the stock market mostly down last week. Luckily, because of these 3 questions that I ask before I invest clients' money, I didn't actually have a lot of calls from clients that I had to field, which was nice. But if you invest money based off of these 3 questions, then you can have confidence when the market does crazy things or the market's going up, knowing that your money's invested appropriately for you. So let's jump into it. Number 1 is attach purpose to your investment dollar. So the question is, what is the purpose of your investment account? If the purpose is retirement and it's a long time away, then we look at last week and say, hey, this is one event in a lot of events before you get to retirement. So it doesn't weigh on you as much. If the purpose of your money is you're needing it much sooner for a down payment on a house or something along those lines, you don't have as much time to recover. You don't have as many different market events to happen, so the money needs to be invested less risky or in less equities. The second question is, what's the likelihood you're going to need to touch your money or access your money before the intended purpose? So, for example, let's say you don't have a large enough emergency fund on the side and something happens and you need to access your investment funds. Then you don't want to be exposed to as many equities, so when the market drops, your account won't drop as much. If you are someone who's got a lot of money set aside in less volatile investments, a savings account, for example, then the chances of you accessing your investment account are lower, so therefore the risk and the volatility is not as impactful on you at the time. Third question is, what is your risk tolerance? Asked another way is, what can you stomach when you look at the market? If you're someone who freaks out when you see the market's down, or if you're someone who's constantly checking your account value and you're more nervous about your account, then you might not want to be invested in as many equities. So really, depending on how you answer these questions, depends on how I construct your investment portfolio. Again, if you're a client, you've heard me talk about these questions before. If the answer to any of these questions has changed, reach out to me. If you're not a client and you've never looked at your portfolio through the lens of these 3 questions, I highly recommend that you do. If you'd like to reach out to me and let me review your accounts for you, I'd love that opportunity. Email me at Eric, E-R-I-K, at plan-wisely.com. Like you, I'm hoping for good markets over this year. I think we will see continued volatility, but I do think the economy is still relatively strong, and I think we can reasonably expect some positive results moving forward. Thanks for watching.